All right, guys, let's get this show on the road. Okay. So we only finished the first bit, or the first part, where we calculated the cost of capital, or in other words, the interest rate for each of the sources of capital, right, or the components of our capital structure, right? So now the next part here, they're asking us to calculate the break point associated with the company's financial situation. Okay, so the break point, we're basically saying, remember when you're looking at your weighted marginal cost of capital, right? We are saying when we add more capital, right, or we go and source additional funding, and at some point it's going to change the WACC. Okay, so our weighted marginal cost of capital basically shows us where that is. Okay, so in our case here, they told us that we have 250,000 available in retained earnings. Okay, that was the limitation. For all the other sources of funding, issuing additional shares, the corporate bond, the preference shares, there was no limitation. Okay, so to find our break point, if you look at example, I think it is 11, 1.11, they show you the formula which I've left there on the corporate. Sorry, I lied. It's example 1.12. This is the formula here. Well, just above the example, you see the formula. And they're talking about break point. So it's your component funds available divided by the weight of the capital structure. So only where you have a limitation of the available funds are you going to do this calculation. Okay. In the example here, you'll see we had retained earnings 250 and we had borrowings from existing debt facility 400. So we had two limitations. In the question 1.5, we only have one limitation, which is your retained earnings. So I'm just going to call it RE was 250,000. Okay, but now what was the weighting for RE? What was our weight for equity? It was 40%. Yes. So we then say 250,000 divided by 0.4. So and this so basically tells us that our weighted marginal, our WACC is going to change for every additional rand of capital raised past 625,000. Okay, right. So here we go. You'll see just now where we're using this. So part 3 and part 4, I did not bother to, well, we're not going to bother to actually do because this is calculating the WACC and we don't have to. So, but we'll, yeah.
So that answer for question 2 is 625,000.
That's the answer.
So that is your
rand. Yes. That is your break point. 625,000. So here, remember in part 1, we calculated the costs of each source of funding. Okay, and then we just times it by the weighting, and that's how we're getting this WACC of 10.61%. Okay, now if we look at part 4, it says calculate the weighted average cost of capital associated with the total new financing above the break point calculated in part. That should be part 2. Okay, so the break point.
Yeah.
Okay. Actually, I thought of doing this when I was actually just reviewing what we're going to do today. We have 3 sources of financing, isn't it? Let's see. Do I have a table there with the financing target weights? I want to look for the target weights. Yes, here we go. Here's our capital structure. Can you see that? So let me actually copy this. Bring it back down here. Right. Now, remember we said
That our equity is 40% of our total funding, isn't it? We say that we only have 250. That's our cap, our limit. We can't get more capital from equity than 250,000. Okay, but that's not all our source of funding. Does that make sense? It's not all our source of funding. So if we are to try and establish what is the total funding that this business then can generate, taking into account that limitation of equity, we then, I'm going to put a column here so we can get our, in fact, I'm going to add a row and then I'm going to put a column to the right here. Funding. Okay. So we already know at our limit, we have 250,000, isn't it? That is 40% of our total funding. Then 10% is what? If this is 40%, we can actually quickly just do a, what do you call it, proportion calculation to get the what the total should be. I'm looking for this thing and it's right here. Okay, so we can basically just do this. We can say we want 100%, our total funding. But we know 40% is equals to 250, isn't it? Can you see that? So then, what's our total? Boom, there you go. What we just calculated, 625,000. Okay, so I can actually throw this in right here. 625, which is our, what's 625? Our breakpoint, okay? Okay. So now 10% of that is going to give you 62,500. And 50% of that, you add those two, you should get 300 and what? 12, I think? 500. Again, if you add all of those up, you're going to get to our breaking point of 625. So our breaking point, we're basically saying, if we do not take on any additional funding by means of either issuing new bonds or issuing new shares, this is the total funding that we can get. And at this point and below, the cost of our funding, our WACC, in other words, is going to remain constant. But the moment we go and source 625,000 and R1 and more, our WACC is going to change. Because when we go and borrow more money from FNB, they're also going to charge us. Can you see how that's going to increase our WACC?
So just when it comes to this, principle innovation rates is 40 year savings of the year. And how people here is funds.
Yes.
I would say this. Like this.
Yeah. And you'll see we're not done with this concept. So it's good you guys are asking questions. So you'll see that we are actually going to need this as we go further. So now, part 4, they're now saying, calculate the WACC associated with the total new financing above the breakpoint. So can you see above the 625,000, which means what? We would have needed to source additional funding if we're going above the 625,000. How would we have done that? Remember, we calculated it earlier. Remember, this is what you are mentioning just now. If you read the retained earnings, it says any additional capital would need to be sourced by way of issuing new shares. So how are we going to have a total new financing above that 625? Through issuing new shares. So the issuing of new shares, what was the capital, the cost of capital we calculated? Is this 14.71%. You see that? So now when doing our WACC calculation, instead of using that 14%, we would then use the 14.71. Can you see that? And equity, the weighting still remains. It's only the cost that change. And look at what has happened with our interest rate. From 10.61, it's now increased to 10.89. Can you see how getting additional capital has increased our? Okay. Yes.
But a higher price than outside home cost.
Because it puts the business under more pressure, because it's saying whatever investment opportunities we get, again, we need it to be even higher than before. Because before we said we just need to make sure that we are beating 10.61. And then we know we are increasing shareholder wealth. Now we need to be beating 10.89. Okay, so we have those two, right? Then here we move on to the last. Is this the last part? Second, yes, it's the last part. I've just broken it down. So here, okay, we can actually now draw your weighted marginal cost of because now we have the two X. Does that make sense? So on this, let me just push this step further down. You know what, Ne? I don't trust my drawing skills. So I'm not going to do this to myself. I'm just going to copy the image that you get there in the back of your book, and we'll just explain it as we go along. Okay. Okay, right. So for some reason, the WACC that David calculated, sorry, the weighted marginal cost of capital, I think it's an error because we are getting the same figures in terms of parts, the two parts where we calculate the WACC, but for some reason they're using 10.59 and 10.8. But you get the point. Can you see from here all the way until 625,000, we have one WACC. And then when we start getting additional capital, what happens? It increases. Okay, there's your weighted marginal cost of capital. Can you see it? Okay, right. So we're happy with that.
So, talking about the issue of new shares.
It doesn't always have to be new shares. The question, guys, because sometimes we might issue bonds. But maybe previously we didn't have any bonds that we had issued. So in other words, we're getting corporate debt. Can you see that?
Yeah, yeah.
But in this question,
Because this, the wording of this question, nothing, 3 or But it's associated with the total new financing below the break point calculated. Then that's how you're supposed to use the default rate. And the other one is saying, the total new financing above the break point default rate.
So remember, the breakpoint is telling us at what point are we getting additional finance. So we know that our limitation is only the equity. And then we are using that. That's called 250 divided by 0.4. It's basically just us doing that proportion calculation. This is a different way. We could have actually just gone 100 over 40 and 250 to get the whole break-even point. Does it make sense? So whichever calculation works this way, you use it. Okay. I just want to follow the calculation, but I will probably use the proportion. Okay. But the whole point is the break point is the point where we don't need to go against additional capital, right? So that is how we then know the WACC for that first question that you bring is obviously going to be the WACC that we have where we haven't got it based. And then past that point, we're then using the WACC where we have to go and use equity. So yeah.
So what are the actual considerations?
Which ones should we go with?
I'm saying, so honestly, judging for.
Yeah. Just an earlier question. So different companies will come up with different reasons, but one of the primary reasons, remember we have tax deduction when it comes to bonds. Also, remember we can issue endless amounts of capital via bonds and still retain control. Because if we issue via equity, guess what? It means now we have more people coming into the business who also want a stake in the direction in which the business goes, who also are going to enjoy the profits. Because remember, when we issue debt, when we get debt, we pay them a fixed installment. We don't, so if we make crazy profits from the opportunities that we've taken advantage of, we get to enjoy the benefit of that additional profit. And we still just pay 10,000. Can you see that? So it really depends on what you're solving for. But here's now the downside. If business is not going great, tough economic times, and you still need to pay that 10,000, but our sales or our profit is way lower than it used to be. And you see the financial pressure right now. So it really is about what are you trying to achieve? What is most attractive to us as directors of the business? But yes, so typically you'll see if a company can raise money via debt and they're very confident in their revenue stream, they'll raise it via debt because it's a cheap option. But it's also that you need to be more savvy in the manner in which you operate.
Different like share process. What's the?
Are you going to?
No,
I'm just saying.
yes, the thing that intrigued me about it was that better now.
Yes.
A large for the massive but Zuckerberg's will retains all of the promoting rights.
Yes.
So it's with that essentially others, but nothing moves unless.
Yeah.
So is that like a visual thing? You see like smaller big cap company splitting, or that just something you can say this is
No, it's not about some scale. It's about the type of ownership. It's now speaking to what you just raised earlier, where if you buy class A, if you buy class C, or some will give you voting rights. And also remember, voting rights might not be. You might have two, Thomas might only have one. Makes sense. So your vote weighs in. And then there's also the thing of, let's say, for instance, I don't know, certain, but let's just say, Mark Zuckerberg holds 40%. But nobody else owns the straight up. He just needs an 11%. And you see how he's still controlling the company without owning all of it. Same thing with the Ford family. I believe they might only take about
or something like that. They don't have the controlling, but they're still able to control it. So it's all about what portion of interest, what type of ordinary shares you have, and so on and so on. Because remember, some of us might own a JSC share of a company, but it doesn't mean we have necessarily voting rights. You see. So it gets very technical, but I don't know if that's within the scope. But yeah, those are the conversations that we should be having as finance
Professionals. Okay. You must remember, you don't want to give everyone control. Not everyone is going to lead us the right way.
Some of these companies you track the time of so they have like a stack share price.
Yeah.
Also, yeah, but
Yes.
and almost wonder if I was the public domain,
Yes.
but public scrutinize like most of these shares.
Oh, and stuff like that.
Yeah,
It's quite possible.
especially when it comes to like different buyers.
Yes.
Like all of a sudden, 40% is up for what we said. Someone else felt one. So you think it's bad. Somebody was like that's 10, 12%.
Yeah.
Okay. Just start with the side of this was actually quicker. That's the like
Yeah, that's why some people, when they buy into a company, they also sign agreements that you can never sell. Let's say management will say you can't sell the company without making those shares available to us first. Because what happens when you sell everything to who's coming in with a liquid file, private equity firm? I'm going to retrench and try and make this company as profitable as possible. And usually the easiest way, fastest way is you fire people because salaries and wages is the highest expense for most business. And you see, which means that I'm losing my job the moment you sell the company. You see, so that's why you find we start to insert certain clauses. It's so yeah, but it's beautiful. I mean, that's the nature of the game, right? That's the nature of the game. Okay. Right. So I wanted to just quickly tap into this. We're still good for time. So yeah, there's our before raising additional funding, our breaking point, and then forget about this P1, P5 for now. It'll come together just now. But the whole point is, remember, this was the first whack that we had, and this is now the second whack after raising additional funding through issuing shares. Cool. So now moving to the fourth thing that they asked us to do. They now ask us to, using the above information on a single graph, prepare the weighted marginal cost of capital schedule and investment opportunity schedule. Okay. Decide which investment opportunities the company should undertake. Right? Now, here is your investment opportunity schedule. You guys are managing a hedge fund. We have investment opportunities coming left, right, and center. Obviously, we analyze which ones are the best investments. So we do our IRR calculation, right? And we get the difference. And we know that by studying the different investments, we know the initial investment that we need to put in, all right, in each of the investments. Okay. So why is this important? We don't have unlimited amounts of capital just available. Okay. So first thing that you do is you say, okay, yes, I've got my 6 investment opportunities. I need to order them according to the ones that are going to give me the highest return. Because obviously we don't want to invest in something that's mediocre. Right? We want to get the most bang for our buck. Does that make sense? Okay. So in the test or the exam, they'll just give it to you like this. You need to then sift and order things in terms of highest return. So the highest one there I see is P4. Okay. And then you'll just, I'm going to save us some time. So I'm just going to actually copy the ranking here. But I wanted to just quickly show you. I thought we might rank it together, but that's fine. So your step number one, this is before having drawn the graph. Okay, it's just your lecturer is not a great drawer, so
We just jumped the gun there. So here now you can see P4 is your highest return, P3, and so on and so forth. Can you see that? Okay. And here you can already see base, and now we also have added the cumulative total. So we're saying, okay, if we only invest in project one, P4, we only need 440. But hold on, these are also great investment opportunities. So if we invest in the first two best investment opportunities, 740,000 is what we need. If we invest in the top four, because we have, let's just call it 2 million, okay, then we're going to need 1,950,000. Okay, so this is the relevance of that last column.
now we can now plot these on a graph, right? Now that we've ranked the investment opportunities, and that is exactly what's happening here. So you can see, what was the first interest rate or return? 17.75. So there you can see where that's sitting. Can you see that? And how much did we need for that one? 440. Can you see where I should use a different color for this? So there is your, and if you take this down, you would end up at 440. You go to the second investment opportunity, which is 13.5%, and that's 300,000. So 300,000 from 440 is going to take you to the 740 cumulative. Is it 740? Why am I like passing 800 there? Okay. Yeah, that might be the case, but you get the point, right? Okay, and here you can see it is sitting at the 13.5% there. And you keep on doing the same.
This was the last thing we discussed when we were looking at the slides. You've drawn your investment opportunity diagram. Can you see that? And we've also drawn the weighted marginal. We will invest in every opportunity, assuming we have the funding. That is above our cost of capital. Does that make sense? So if we say we're only going to, we're not going to raise additional funding, we'll then obviously only be able to invest in people. But if we say, no, we can raise additional funding and we can gain returns that are higher than the additional funding, why not? Because it means we're going to make money. Okay, we're going to increase shareholder wealth. So we then say, okay, cool. But how much more additional funding are we going to continue to go and seek to raise? Okay. P3 is still profitable. P5 is still profitable. P1 is still profitable because all of them are beating our weighted average or weighted marginal cost of capital. But P6, can you see, is below. Are we going to invest in it? It's not, because it's going to destroy shareholder wealth. And this is why we were saying that where
your investment opportunity schedule and your weighted marginal cost of capital lines cross
is the point at which you are going to reject anything that comes after. Only invest in the things before that. Can you see that? Is it making sense? Right. So guys, you have gotten your school fees for today. Goodbye and good dance.
to the WACC calculations. Yes. Okay, to both of them or one of them? Okay, I can't show both of them. Okay, let's try this. Okay, that's about, oops, sorry. That's about as big as I can go.
You can see this 10.89.
So the 14 straight percentage there.
Uh-huh.
Is that for the shares?
That was for the retained earnings
The retained earnings?
before we issued new shares.
So when we issued new shares, it was 14.7.
Yes. And can you see something? We calculated that.
Yeah.
We calculated that. Can you see? So it's above it. Okay. Right. So guys, this is definitely something you want to practice and just make sure you're comfortable with. That's about as far as it goes. That was the last thing that they asked us to do there. All right. So yeah, the next time I see you, we will then just quickly discuss revision question 5, and then we'll go